Excellent. Thank you, Ian, for the introduction. And Ian and Mike, thanks for inviting me to present. And Ian, I think you've pretty well summarized my presentation. I'm not sure what's left for me to say, except for how do I control my screen. I just want to point out our disclaimer on forward-looking statements and dive right in. So we're a Canada-based specialty pharmaceutical company. We've got a 12-year track record of profitability. We focus on bringing unique and differentiated products to the Canadian market and commercializing them. Sometimes those products need to be taken through the Health Canada or comparatively the FDA approval process. And then we take those products to market by introducing them to healthcare professionals, pharmacy, hospitals, and patients when we can communicate directly to patients or consumers looking for healthcare products. We source these products globally. We have looked in the past primarily at in-licensing activities. Sometimes products that we in-license are already approved, so we have a shorter time to market. I would say in the last year, we've looked at more acquisition of in-market opportunities, either individual assets or products, but we have looked at divisions of or entire companies, and there's been more of that activity than we've had in the last, I would say ever. We target products are late in the market development or late in the development cycle. We're not early stage. So if you're not a healthcare investor or not normally investing in pharmaceutical or biotech, or maybe a name you can pay attention to, we're not an R&D and a science shop. We do some development on new products, but I would call this on the continuum of risk and complexity fairly simple. We leave kind of the more development activities to other companies that are well suited for it. And quite frankly, we've found quite a nice niche in running a profitable business the way we do with our focus. So the interesting thing and quite satisfying, quite frankly, for people that work in our industry is quite differentiated from other industries, and that's that we get feedback from our customers and from patients and consumers all the time, literally daily. And sometimes those messages make their way to me directly in the form of how we've impacted or improved lives of the people that take our products. And it's something that allows our people to spring out of bed in the morning. So this slide here, if you I think Ian's probably going to circulate the presentation itself, and I'd say this one kind of says it all, along with what we see as our growth drivers going forward. So I've mentioned that we've got a 12-year track record of profitability. Last year, our revenue was just under $29 million with EBITDA just under $9 million. Our earnings per share was 49 cents and our return on equity 21%. So that is kind of in line with the types of results and ratios that we've had in the past. And we're doing this while we're launching new products. So we've got new products, 2 new products that we consider to be in launch mode. One now 2 years in market and another about 1.5 years in market. And we've got 2 additional products coming for launch soon. And what we would describe as our portfolio in our control. So, no further Health Canada approvals required or any additional in-licensing or acquisition. Our portfolio supports a top line in the $50 million range and above. We have a strong balance sheet. We have no debt. We do have operating lines of credit available to us. We have about $28 million in cash. This is as of our last disclosure on June 30th. And what we've been doing over this last 10, 12-year period of time is not just increasing sales and profitability and generating cash, but we're building a business that has durability, and we've been building process, systems, people, infrastructure, a national sales force. I would say our sales force is the largest or amongst the 1 or 2 largest sales forces of a Canadian pharmaceutical company that isn't owned by a multinational parent. We have 9 products that are approved for market. I talked about the balance sheet. We're well capitalized. The last time we went to market to raise equity was 2002, so 20 years ago. Ian alluded to our share buyback, so we've initiated NCIB in December of 2018 and reduced our shares outstanding by about 14% in that 3.5 year period of time. And that cash on our balance sheet works out to about $2.19 on a fully diluted basis. We have an experienced management team, long tenure amongst our leaders in the business. And if we kind of talk like owners and you think like we sound like investors, it's because we are owners and investors. 25% of our company is owned by insiders, excuse me. So a quick look at our brands. I'm going to touch on a couple of those in a moment. So how have we done? This is a 10-year look at our revenue growth and our net income after tax. So the green bar is NIAT. Using 2011 as the base year, we have a 30% CAGR for both revenue and net income. And what's quite interesting here is if you pull out the investing that we're doing on launching new products, our profitability would be significantly greater, but we've determined that our key focus strategically is to grow our business, grow revenue, and to diversify our portfolio. And so we're making investments in licensing and in preparing assets for market and in launching products. So I would say that if we were just content to manage a business the size we have now, we would be quite a bit more profitable than we have been. So I said I'd do a deeper dive on a couple of products. So Ferramax is a brand that our company owns. It is not in-licensed. We own the mark. We launched this product 13 years ago. And in the last 7 years, it's been named the most recommended oral iron supplement by pharmacists and physicians across Canada. So that's now 7 consecutive years, and it's given us a tremendous platform for innovation and expansion of the Ferramax product line for iron health of Canadians. So we are working on several initiatives that you would expect a market leader to do, including education of healthcare professionals, of pharmacists, and patients and consumers for that matter. And we're working on bringing further innovation to the market behind this brand. A couple of years ago, we introduced a new formulation of Ferramax and used that as a platform for new products and for future new products. So we changed the formulation platform for the product to a polydextrose iron complex. It's a patented formulation. And we used that then to change the formulation in existing products in market. So Ferramax 150, which we initiated late in 2020. Ferramax Powder, which is now known as Powder 15, was launched about this time last year in October of 21. And as I've said, we're using this platform as a jumping off point to further innovation. So we've got 2 new products that are in development. One is going to be in market soon. We have another likely for a 2024 launch, and we've got a couple of more products that are on the drawing board. And I'm not sure kind of when and if they'll see market. We're also doing some things to support customers for this brand outside of Canada. We have a modest history of sales of this product outside of Canada, and we're working with overseas customers on implementing some of the innovation that we're introducing to the Canadian market. So in addition to Ferramax, we have other growth drivers. We launched menopause hormone therapy Tibella for vasomotor symptoms of menopausal women. We've launched Combogesic, a pain medication, about a year and a half ago. We've got a new women's health product approved by Health Canada. We're preparing that product for launch. That will see market in the earlier part of 2023. And we've got more people working on in-licensing and pounding the pavement for acquisition than we've ever had before. We're investing in this growth. You can appreciate that relatively when you're investing in a product and it's not near its peak potential, the amount that you're putting into sales and marketing is greater, proportionate to the top line. We've expanded our sales force. We're putting more into marketing resources. I would say that you saw the jump up in our 21 spend versus 2020. Maybe not so much in the year-to-date results, but there's further investment going on in the market in terms of priming the market, driving awareness of new products, driving sampling and trial of new products, and then conversion to prescribing or recommending habits by healthcare professionals. So 2022 hasn't been without its challenges. You've probably heard the word COVID-19 sometime today or yesterday or sometime in the last 2.5 years. We're in a better place now with COVID-19 than we have been since March of 2020, kind of wave one. But I would say in terms of 2022 impact, it was certainly in the earlier part of this year. It's had some impact on our launch products in terms of access to healthcare professionals and patient traffic to go see their doctor. Of late, the last 3-4 months, that's as good as it's been for us since COVID began. You've been hearing about supply chain more broadly, not specifically, obviously, to pharma, but more broadly, we're not immune to the impacts of supply chain impacts. We've noticed that on some products that are in market where we've run very close to the line in terms of availability of product. And importantly, the products that I've mentioned, the Ferramax product and the new women's health product that we expected to get to market slightly sooner than when they will see market, though we think it certainly in the first half, maybe just after the beginning of the second quarter of 2023. And the last thing here I want to talk about is inflation. We've seen inflation pressure both on cost of goods. We've seen it in moving product. I guess that's related to supply chain, but certainly been just moving product from manufacturing sources to our markets has the cost of that has gone up. But we've seen it in impacts on other services to support our marketing efforts, and in fact on people as well. So there's been, I think, the inflation environment that the business leaders are working in today is different than it has been quite literally for decades, and so new challenges for our business. I would say what gives us comfort is that we have a strong position in the market. We've got some leading brands. We are generally a high margin business. Our pre-tax operating margins have had some history operating above 30%. And our net income margins certainly operating well north of 20%. So, not that we like an inflationary environment, but we certainly can manage it. And we have a strong balance sheet, which allows us to make investments in working capital that perhaps protect our margin better than we could if we had to borrow to operate our business. In terms of progress this year, I've mentioned that we've been building out our national field sales force. We've added resources in terms of medical support, both for our sales and our customers, healthcare professionals. We're investing in the Ferramax product development and getting products ready for market, which are not yet generating revenue. So that's all happening kind of like the duck on the pond, where the pond looks pretty calm, and you kind of look at BioSyent and you say, that doesn't seem to be much going on. I would say there's a lot going on. It's just our feet are paddling under the surface of the water really hard right now. So last month we reported our first half results, and I'll just touch on a couple of slides that I've lifted from that presentation deck. Here you see sales, EBITDA, and net income after tax over 2020, 21, and 22 for the 6 months ending June 30th. And you'll see on the top line, our business was down marginally in revenue. And that requires, I think, a little bit of explanation just to understand if you're not following what we're doing. We made a decision at the end of last year to discontinue, actually made the decision more than a year ago to discontinue 3 products under 2 brands that we didn't see either growth rate or profitability or the further investment that those brands would have needed, giving us an acceptable return on investment. And so we discontinued those products and gave them back to our licensors. And so you see our Canadian business was off slightly on that basis. And we think over the long term that we will not just replace the revenue that we gave back, but we're going to replace it on a more profitable basis. And you can see that in terms of financial or profitability, both EBITDA and net income after tax. You see those sales were off slightly, profitability was up. So how is that translated into to earnings on a per share basis? What you're looking at here are the last 8 quarters of diluted EPS. So on a TTM basis, 12 months ending June 30th, we earned 50 cents, and that's up versus the 33 cents in the previous 12-month window. So we're cash generating, and for years we've been building a strong cash position. You can see here how that cash position has grown over a couple of years. This is once again 12 months ending June 30th. So you see our cash position growing from 21 to 28 million. We've got a very strong working capital position and a return on equity of 21%. So the obvious question that we get is, okay, what are you going to do with the cash? What is your intention, and how will you deploy that capital? So we have been buying back shares. So through this period of time that you see our cash position growing, we have been buying back shares. In the latest 12 months, we bought back about $2.5 million, just under 314,000 shares. So we've been active. We're not one of those companies that announces an NCIB as a kind of a defensive measure to a stock price and then doesn't do anything about it. And that's worked out quite well for us. And I'll speak a little bit more about some more details there in a moment. So, Rene, what do you intend to do with the capital? So $28 million in cash. We have additional financing capability through debt. We have no debt now, but we've got access to additional capital. And so we think about capital allocation as it links to our strategy. So our first use of capital is to grow our business and to diversify our portfolio. Those are absolutely our top priorities. I've been speaking at great length so far this afternoon about new product introductions coming to market and how we're leaning in and spending more in selling resources and in marketing resources. What we have found is, despite these investments, or I suppose because of those investments, our business is growing and cash generating. And we think that a reasonable alternative is to return capital to shareholders. So we've been doing that through share buybacks. And as Ian has mentioned, we have signaled, though no final decision taken, but we have signaled to the market that we're likely to start paying a dividend. Let's call it soon. And we think that this is a wise course of action, and there may be some questions about that as we go on. So I just wanted to circle back to the NCIB. So just some facts for you. When we started out in December of 2018, we had just under 14.7 million shares outstanding. We've repurchased to over 2.1 million shares, and that represents a 14% reduction in shares, $13.5 million of capital deployed. The way I like to look at this is, okay, what tangible benefit have we got for each share in the company? So if you just kind of work it out on an earnings per share basis, that's had a 16% benefit of going from 43 cents if no shares were bought back to 50 cents a share if under the course of our NCIB. What's important to know here is that we're not buying back shares and leaking them back out into the market through equity compensation. So we very close to simultaneous with our new NCIB, we have paused using stock options as an equity compensation tool. So since 2019, we have not granted any of the stock options to anybody in the company. And what we've done is we've moved to RSUs, restricted share units, and this is now our form of equity compensation for managers and leaders in our business. And what we're doing is quite interesting. We've got a strong balance sheet and a strong cash position. We're in the market buying back shares. So this is in addition to our NCIB activity. We're buying shares. I shouldn't say buying back. We're buying shares in the market, holding them in trust to satisfy our future obligations under the RSUs. So it's a very, what I call shareholder-friendly approach to the business. We think there's a lot of growth in the business, and we're leveraging our strong balance sheet and the fruits of hard work now over more than a decade for the benefit of all stakeholders in our business. We think this is the right thing to do for our shareholders, but our kind of prudent approach to managing our capital kind of works out for all the stakeholders in our business. Just a quick snapshot at our cap table. So there's some puts and takes with those RSU shares. I would say that the key numbers to focus on is just under 12.6 million shares outstanding, and our market cap based on this share price here is about $100 million. So I'll wrap up my kind of formal remarks and presentation with a message about how excited we are with the growth prospects in our business. We think we're well positioned with our balance sheet to take advantage of some opportunities that may present themselves in the very near future with respect to other companies with more leveraged balance sheets and potentially being more significantly impacted by rising interest rates. We think that it has appeared to us so far to turn up some new opportunities for us, and I think for others it may get worse. I think it's highly likely to get worse, and therefore I would translate that for BioSyent to get better in terms of giving us a greater buffet menu of opportunities. And I'll wrap it there and ask for any questions.
So Rene, I think you're talking a little bit about deal flow there. How would you say it compares to what you've seen over the past several years?
Yeah, so there are two types of deal flow. One is M&A, and the last 12 months are far and away more on M&A than we've seen probably in the 5 years before that, maybe longer. In terms of in-licensing opportunities, even though we're deploying more resources against it, we've not seen we've seen as much in terms of in-licensing activity as we have in the past. We monitor that metric, and we've got a software tool to help us kind of manage deal flow and the time of each asset in our funnel. We've got more on opportunity side for in-licensing than we've had before. We've got a number of things that we worked on over the course of the last 9 to 12 months that at the 11th hour fell out. Sometimes clinical results didn't bear out on the final readout before kind of taking it to the next steps, and sometimes for other reasons.
Okay, so there was a number of questions that were asked by the audience on the decision to give a dividend. So the first one is, why not do more open market purchases versus dividends?
We've got there are a number of factors that we've considered in the process to go to consideration of a dividend. One of them is that as we've been buying, it's hard not to notice that it's had an impact on liquidity generally, and it's getting over time more difficult to get access. The rules for buybacks for a TSX venture company have us somewhat boxed in. So I think we've looked at adding an additional tool to return capital to shareholders, but it's not intended to be an either-or decision. It's meant to really open up our toolkit and give us additional optionality there.
So related to what you last said, what will be the process or philosophy for how you allocate capital between dividends and buybacks?
Well, I mean, we haven't finalized our dividend program, so I'm not going to dive deep into that. We have been disciplined even with share buybacks. I mean, we've been deployed about $13.5 million. We don't chase the market, and we have been disciplined there. I think we will continue to be disciplined. I would say that the intention is not to reduce the amount of capital we have on our balance sheet. The intention is to keep the cash on the balance sheet from growing disproportionate to the business itself. So we'll have a balanced approach, I think.
Okay, so what's the biggest barrier to faster growth, or biggest barriers maybe?
I think we've got a couple of issues. We've had some heavy lifting through the COVID period with respect to access to our customers and so healthcare professionals and their access to patients. And by the way, it started with patients not going to their doctor, but lately in the Canadian healthcare system, it's well known that doctors have reduced their number of consults with their patients. So it's been a kind of a tricky process when you're in the market launching new products. I'm not sure I would describe our growth rate last year as slow growth. So it'd be great to grow your business every year by 25 or 30%, but and some of it has been timing. We've got a couple of products that we'll see market here now soon that we would have expected to be in market sooner.
All right, so the next question is, how does BioSyent differentiate itself?
Well, I guess there's a number of ways to think of that question. I think of how do we differentiate ourselves to our customers, and I think that really is dependent somewhat on the products that we're offering to a very specific audience, and that we're not promoting all of our products to the same HCPs. So we are professional with our approach and supportive to healthcare professionals. Another way to kind of tackle that question is how do we differentiate ourselves to other potential partners in the Canadian market as a commercializer of pharmaceutical or healthcare assets? And I would say that one easy way to differentiate is to potential partners, and we spend very little time now kind of giving them the credentials story or the credentials pitch. I think as we're a listed company, we're fairly transparent, and anybody who wants to check us out has access to everything they need to know to whether we are a successful commercialization company for assets. And I think the transparency of our business and our business model, and then our success and our balance sheet and our revenue growth, I think that pretty well speaks for itself. So I don't know how else to kind of address the differentiation, but really our products are the key differentiators, and we're always looking for products our products are all differentiated from their competition.
Where do you see BioSyent in 5 years?
Bigger, more profitable, more assets in the market, and more assets coming to market.
Okay, I think that's our last question.
Maybe I'll ask one or two more. We've got a couple minutes left. Rene, as it relates to new products or in licensing opportunities, I'm curious if what you look for has changed over the last 5 years.
Yeah, I short answer, yes, and I'll give you a little bit more detail. I would certainly say deal size, like the peak penetration revenue opportunity that we're looking at has moved up on the continuum in terms of size. Our approach, though, to focusing on unique and differentiated has not changed. We do take some care to look at what our share of voice will be in a market. And so that hasn't really changed in terms of approach, but we have got a number of assets that are promoted in the family healthcare office, the GP's office. And I would say that right now we have quite a lot of assets that are either in market or coming to market that are going to be promoted there. So we are quite interested and are spending more time focusing on specialist assets. So with a smaller universe of call points to balance out, because we can't necessarily shove more products in the sales bag of one individual rep with one customer. So I think those two things I would say have changed in our approach.
Okay. And maybe one last question about Ferramax. What percentage of that addressable market does Ferramax have in the Canadian market? And I know you're developing some other products under the Ferramax brand to perhaps get more share of that market. Can you kind of go over those? How should we think about the opportunity with Ferramax?
Yeah, well, there's, we're seeing growth with our base Ferramax business. So the two Ferramax products we have in Canada are still growing. They had significant growth last year, a little bit more modest. I think what's been publicly disclosed, and then compared to, we obviously know how did we finish the month of August and how are we tracking in September. So I'd say we expect there's more growth in our Ferramax 150 and Ferramax 15 business. The share is, I think it's under 12% measured in units. We have a high dollar share, but that's, the way we look at that is we have to convert the whole market to a Ferramax dollar. It's a super premium product. Mm-hmm. Our new products are going to modestly steal share from the existing market. I think it's going to grow. It's going to grow the market, which is something that you would expect a leader to do. That's our approach. It's not just to kind of eat somebody else's lunch. We think we're going to be offering something that's unique. Certainly, our research that we've done so far has indicated the feedback from doctors, both GP and OBGYN and pharmacists, is indicating that we're going to capture new markets, help doctors think about iron health differently.